you straddled the middle stand or act like a middle stand until you're ready to be a startup.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Neil Thanedar with us. Neil is an entrepreneur, investor, scientist, altruist, and an author. He is the founder and GP of Utopic Ventures, a pre-seed biotech VC fund investing in the future of science. In this episode, we talk about Neil's story and how he started investing, what are Mittelstands, why startups should stay indie as long as possible, what's their focus at Utopic Ventures, Biotech 2.0, and lots more. So without wasting any time, let's dive straight in. Hey Neil, so good to have you on the VC 10X podcast. How are you doing?
I'm good. How are you?
I'm doing great as well, and pleasure having you today on the podcast. And I loved all the blog posts on your site, very intriguing. But to start this conversation off, can we first have your story and how you started investing?
Sure. So yeah, born and raised in St. Louis, Missouri. A big part of my story growing up was my dad quit his job as a chemist when I was 2 years old, and he started a one-person testing lab. And so I really saw that lab grow for many years. Like it started in St. Louis with just kind of one building, two different rooms. I would be in the front room, either just playing with stuff, reading a book type of thing while he was working. And so really got used to that. And for many years, he'd kind of bootstrapped for over 10 years, eventually started taking bank financing to make acquisitions, got the company over 500 people by 2008. And then he lost the entire business in the 2008 recession. He basically had a couple of bad quarters. The bank took the business and sold it for the exact amount that the loans were. And so, 100 million plus in value was basically evaporated in months. And so I was at the University of Michigan getting a molecular biology and business degree. And I really wanted to start a biotech company. That was my plan. I was applying to Genentech internships in the summers, and that was my focus. But when 2009, 2010 hit, we had to do something to save the family business and do something new. And so we started a 2-person testing lab in Ann Arbor, Michigan, just me and my dad. We were doing either switching between the phones or the testing website or sales, a lot of everything. We eventually grew that business. In 2 years, it had 15 people and was profitable. 6 years, it was 50 people and got an initial acquisition. We got a second acquisition more recently. And so the full company is now exited and able to kind of get my dad back on track. And then it also helped me personally see what was kind of next in startups. And so I'd kind of done a very strong small business. And then it gave me the idea for what would be the startup equivalent of this. Like, why are there no B2C labs in America? Why do no one actually give this information to the people who are actually consuming these products? And so I built Labdoor. So labdoor.com with my 2 co-founders, we've built a site that's tested over 1,000 products. Tens of millions of people have used it. It's a really powerful tool for researching and buying the best supplements. And so we really are the independent alternative to the FDA. Now we test CBD and dog food and baby formula and really anything globally also. So like the top protein powders in India and Brazil. And there's a lot in other countries. There's all these different competitors and counterfeits and all these major issues with these products. And so we were able to, raise $7 million in seed Series A financing, went through Y Combinator in 2015. I was one of the first scientist CEOs in YC. Ginkgo Bioworks was the class before us. And so I've seen a lot of YC and biotech as they've come along. I've seen YC grow. YC was a very small, we were the first class over 100 companies. We were the second class that got the 100K checks, right? Like even then, it was a really inflection point. People weren't sure in 2014, 2015 whether YC was going to be as big as it is now. And so I started angel investing very early, like first in kind of other companies in my batch or in future batches. And I've really wanted to write those first $5,000 to $10,000 checks to those companies. And over time, as I kind of helped those companies fundraise more, it was a slightly bigger check that they needed and a slightly earlier stage that they needed. And so I really honed in on this idea of $50,000 to $100,000 checks for biotech. And that's where I'm at.
Certainly, and thanks for sharing that story. I'm sure that's going to inspire many out there. And like you're doing multiple things. You're still the founder of Labdoor, is that correct?
Yes. Yes.
And you're also running Utopic Ventures, which is your venture firm, right?
Yes, and so I think that's a more modern uh, phenomenon that's going to happen more and more. So I think,
Right.
especially with smaller funds, $5-10 million funds,
Hmm.
or even these like 1-2 million a year rolling funds on AngelList,
Right.
I think funder investor combos are really great because you get this great deal flow from whether it's YC or whether it's the other founders around you. There's just so many people who you're doing that work currently, and so you're either fundraising yourself, and so you're meeting investors, right? You're meeting other founders, and so I think the combination is really great.
Absolutely, I totally agree. But what I've seen is like both these jobs, being a founder and being a VC, are like extremely hectic, right? You have to fundraise for your company, and you now also have to fundraise for your VC firm, right?
Yep.
You have to like get your clients in for the company, and then also source your LPs, and then also on the like deal flow side, you have to source these companies.
Yep.
So it's still a lot of work. So are you a solo GP, or do you have some people helping you out here?
So it's solo GP, no one helping
Okay.
in this sense. And so I think the deal flow, a lot of it, what I've done is really developed an inbound deal flow, which
Hmm.
is kind of Labdoor is very much that way too.
Yeah.
Uh, it's an SEO machine, Labdoor. So like we figured out a way where if we make the best content in the world on these topics, we actually have tested, like, so everyone else is writing a blog post about how they tried the protein powder, and we actually took the protein powders in a lab and like reverse engineered them and got the purity and accuracy data. It's just so much better. And I think the similar idea that I'm trying to do with my own investing and being a founder is that I want to write the most interesting things possible, the most ambitious things, get other ambitious optimists excited, right? And that just should be driving inbound to where I'm fielding a lot of inbound, and right, I'm getting hundreds of companies and founders that want to talk to me. And then I can filter through like which ones do I want to recommend to Y Combinator, which ones do I want to potentially invest in. Being very focused on biotech and first check in biotech specifically is a very specific niche. So that can quickly kind of narrow down which ones are investable versus I'm just advising. And so those are some of the ways where I can deal with the deal flow.
Absolutely. Yeah. And that's super interesting that you're able to do these two roles and like do them well. And that's because like of the brand credibility you've built over time because of SEO and stuff like that, wherein you have that inbound deal flow it doesn't require that much effort now from you to like get them in, right? They're just flowing to you. That's great. And that's on on your company side and on your venture firm side. And you have a lot of very interesting ideas shared on your blog post that you keep sharing, and one of the most intriguing ones that I found was talking about the middle class of startups, right?
Yep.
Something that you call Mittelstands, right? So
Yes.
can you tell our audience what are Mittelstands?
So Mittelstand is a German word for a specific kind of company that's meant to be. It's the closest thing to American is like a family-owned business, what we'd call a family-owned business, and it's something very similar to what Avamine is, the first business that me and my dad created. We even like between me and my dad, we call those Avamine style businesses, where it's just, and that goes for anything. If you had a great construction company that made 10 million a year in revenue, that's like, to me, it's a middle stand business or an Avamine style business, and those are excellent. They're like, you can build a great family life on that, right? It's usually a local business that like everyone works in the same building, right? So overall it's like it's a good quality of life for you and your employees. It can be something that's like transformational to someone's life. In a lot of people who say uh, they want to start startups to get rich, what they really mean is not billionaire rich, because I think there's not much difference truly between billionaire rich and 10 million rich. I haven't personally experienced it, but I've met a decent amount of people who have done that, and I really do think that what people want is really in that, $1 to $10 million rich, is that's really what's the freedom and the life that they really want. And so if they're really just optimizing for that, those middle stand businesses that are the 10 million to 100 million revenue type businesses are great. And you can build kind of, in many ways, Berkshire Hathaway started with, a single middle stand, and then grew to many, many companies. And then the middle stands themselves can get very big. And so you can get multi-billion-dollar companies with conglomerates like Tiny. And so there's all these options for it. But I think more companies should try to focus on that.
Absolutely, I totally agree. And I've personally worked for some of Tiny's portfolio companies. So I find that model very interesting that they're just
Yeah.
scooping up like tiny companies and
Yeah.
making them profitable and then
like they keep starting new businesses as well. Like Andrew,
Yep.
the founder, has this
Yep.
idea every now and then, and all he does is he tweets about it. That's it, right? And if he sees
Yep.
that there is interest there's traction, he like gets someone and builds it with him. That's it, or her, right?
Yep.
And that's incredible, right? And maybe
Yep.
it works out, maybe it doesn't, right? If it works out, he scales
Yep.
it. Doesn't, that's fine. Like, but that's
Yep.
an amazing model. I think more people should be doing it, and this model of the middle class of startups, wherein you also
Yep.
retain your quality of life and you're also
Yep.
building a helpful and profitable business.
Yep.
And I think that model needs to be popularized a lot more. I think the default mode of starting a business nowadays has become doing a venture backed startup, that you, once you have an
Yep.
idea, you need some funding to make it work, right? That's what
Yeah. Yeah.
people think, right? So thanks for sharing that, right? And another
Yep.
idea that you had was that you want to create a Y Combinator for Mittelstands, right?
Yep.
So can you throw more light on what that would look like if that comes to fruition?
Yeah, I think that's a separate idea. It's not what I'm actively chasing now, but I think what ends up happening with these two types of businesses is the middle stand type businesses are very popular with private equity once they get to 10 million plus in revenue. The challenge is kind of getting them from 0 to 1 and then 1 to 10. And there are some people, either it's a family business or they have this insider information, right? They can make these middle stand businesses very easily. And so you'll find these repeat founders who are in their 60s and 70s, and this is their like sixth, seventh, eighth middle stand business, and they can just churn them out because it's a playbook, and it's much more reliable and repeatable. And so the likelihood of success is much higher, but the exit value might be lower. And so what we've got to figure out is one way to solve that investing problem is that you want to get very early stage. And so you might have to get in, $100,000 investment at $1 million valuation, get 10% or more of the company in a middle stand, like in a business that's going to be a middle stand. With that $100,000, a middle stand type business is usually a service business. So you can potentially start kicking up, like with spending less than 50K, you might be able to make more than 50K, right? And in that first amount of money. And I think that's very key, is the how much turnover there is, how quickly. If you're able to do that very effectively, then you won't need to raise that much money. There might be one or two other places where a 10% for $1 million, like in 3 or 4 years, might be needed. But there's kind of only a few places where that funding is required. And so I would, if I was a private equity firm that normally buys companies at that, 30 to $50 million valuation, at $10 million in revenue, I would consider investing much earlier, basically creating seed stage private equity, right? Because if there's a kind of the way that VC versus PE is split, it's currently split kind of, the idea is that it's split by timing. It's like VCs are early and PE is late. But another way to think about it is like VC does the risky stuff, the riskier investment, like they're actually going for 1,000x or 10,000x returns potentially, whereas PE is looking for like 5x every time potentially, or 3x, 3 to 5x every time. And so these middle stand businesses are great at this 3 to 5x every time, but you might, if they wanted to be an even better private equity, you could just invest earlier. So you get 10% of these companies earlier on, and it's a PE style model. You might more consistently get 5 or 10x hits, but you're also tracking your own companies. And so those are the types of investors that I think should come earlier.
Right, absolutely. I love it. And let's talk about some examples of middle stand. What do these kind of businesses look like? Because I think that's, since this is not a very popular concept, people are not thinking about the kind of businesses that can get you into the category of 1 to 10 million, right? Fairly
Mhm.
easily, and these are not high cash burning businesses. These are sustainable businesses, and they look quite different from venture backed businesses. So can you give us some
Yep.
examples so that our audience understands it better, that what are actually middle stands?
Yeah, I think my first business, Avemean, is a great example. And so it's a service business, so it's B2B. Often you're going to find B2B service businesses that have large ticket items, so $10,000 plus per customer, $100,000 plus per customer sometimes. But what you can do is you can often try to serve a single customer at a time. You can get like almost consulting light, where in a testing lab, usually in kind of some of these cases, there are emergency type of testing. There's like rush services, and so there's reasons why even people who have their own lab might outsource testing. for speed or for convenience or for like some specific testing. And so in the early days, you can just be very custom to solve whatever custom problem someone has. And that's what we did at AveMean, where like the first month we had one customer and we did an entirely custom project for that one customer. And that was, like $20,000 customer, right? And so I think that was really what started the business. And we probably only spent like $30,000 or $40,000 that month, right? And so it was like we didn't need that. There wasn't that much of a variance in order to get the thing kicking up and running. And so I think those are some of the characteristics that make the business successful. You see it in construction, you see it in manufacturing, you see it in a lot of different places. And Brent Bishore calls these boring businesses. I think like there's an interesting way of kind of thinking through what makes them exciting. And I think we're talking about is like the predictability in some ways that makes it exciting. And then what is also kind of exciting for me personally is the freedom aspect of it. It's like many more people can do this. And so there might be one or two or three orders of magnitude more Mittelstands that are possible to be created than venture-backed billion-dollar startups. There's just like by power law, there are just more $10 million companies than there are billion-dollar companies. And so just it makes more winners.
Yeah, certainly. That should give a better idea of what Mittelstands can look like. Basically, your ticket size is much larger than usual or typical venture-backed companies, right? It has to be,
No,
in multiple thousands of dollars per client at least, right? And that is
no.
how you don't need like hundreds of thousands of clients to make it work, right? It's like if you
Yep.
get a bunch of clients, a good bunch of clients, you're good, right? You're still
Yeah.
making good money, you have less stress, and you're leading a good life while running the business, right? That's great.
Exactly. They're more people-based businesses
Yeah.
generally. And
Yeah.
so you can kind of manage that 10 people to 50 people business. And then it even scales down to one or two people. It can be effective at a small scale. And that's the big difference. The hard part with startups, and Labdoor is like a classic example of the opposite, where Labdoor doesn't work until you have to test all these products first. And it costs like millions of dollars to do all this testing before you even show up to the website, because it's completely useless if you show up to Labdoor and we haven't tested anything yet, right? And so we have to actually do that work ahead of time. And then it drives this marketplace that tens of millions of people can all use the same website. And so AveMean versus Labdoor having the two experiences where in many ways they're actually both Mittelstand businesses, like in terms of size and revenue and all those types of things, but they got there in very different ways. And I think it's more about, to me, like creating value, like as much value as you can create as quickly as possible. And then you can kind of figure out where the exits come along the way.
Right, absolutely. And another very interesting idea that you've shared on your blog post is about that founders should stay indie as long as possible and try not to raise uh, the first chance they get or any money they can get, right? And given the current market as well, it's like difficult to get the money in. Of course, the fundraising markets aren't great right now. So can you talk us more into that idea that how can founders build their ideas and work on their companies without raising external capital, uh, or maybe getting some capital that's non-dilutive, right?
Yeah, I think raising as little as possible is key. It's what Paul Graham calls high resolution fundraising. And so it's like in business school they would call that like just in time production, right? It's like you're trying to be as efficient as possible. You're like only raising the money in order to do the next batch of work, right? And so in biotech, it's often I'm meeting companies that have an idea and for a breakthrough company, and they need $50,000 to $100,000 to do the proof of concept. And then immediately after that, the proof of concept in the lab is then going to need to be tested on at least 10 subjects. And so there's going to need to be a preclinical or a pilot that needs to be next, and that's going to be at least $1 million. And usually what a VC will do, especially a VC that invests 250, 500, $1 million, will try to tell you is, hey, you should do both those rounds together, right? Like raise $1 million now, because you don't know what's going to happen, and maybe your proof of concept fails and you're going to need more money, which is a good answer for them. But the challenge is for you, it might take you 12 or 18 months to raise that million or more, right? And so if you're the kind of person who can raise $1 million in a month or two or three, by all means raise that money. But I think by raising less early, you get more optionality. And if you do, as soon as you start raising, you basically start this clock, right? It's like you basically start a treadmill where you get a higher burn rate, you end up spending more money, and then you're going to need to fundraise again. And so again, what like Paul Graham or Y Combinator would call default alive versus default dead. this idea is if you force yourself to basically bootstrap or raise as little as possible, you find a way to get to a default alive. And there's some potential way where you can kind of straddle the line between the two, a middle stand versus a startup, where you can actually make your business more middle stand like at the beginning. I actually like that as a startup strategy in general, is even if you are eventually going to scale to millions of users, you might just act as if your product is currently only serving a few very high value customers. And so you could make the product very customized for a few people and maybe charge them as early as possible to prove that there's some value there. And so in those cases, you can kind of you straddle the middle stand or act like a middle stand until you're ready to be a startup, and that keeps you indie as long as possible.
Certainly. Yeah, that's a great idea that you shared there. And at Utopic Ventures, you're mostly dealing with scientists because biotech is a specialized space. They come up with an innovation and or an idea, and then you fund that based on what they have, well, the idea they have or the research that they've conducted. So, so you're mostly dealing with these scientific people, right? And do these same people go on to become founders of the companies that they're building? Do they become the CEOs of the companies, or has it ever happened that you think, okay, this is great, the idea is great, right, this can be a thing, but I don't think that this person can lead this company, we need a different CEO? Do you ask them to maybe get a business co-founder, something like that? So would love to get your perspective on that.
I've never asked a scientist to get a business co-founder. I find that some scientists do that on their own. Like they understand that what they're really good at is the science and they want someone to help them on the business. But what I see the most is just the scientist is very capable of being a founder. And I just think I think the core to my thesis is that scientists are underrated as founders. And if you invest in the scientists at the early stages, you're able, and with that $50,000 to $100,000 check goes a lot further, because that scientist might be able to turn right back to their university lab subcontract. This is how Genentech started, right? It was just, they went right back to UCSF. They took that initial $100,000 check and spent it at least half it at UCSF doing that testing. Right. And so I think what you'd want to be able to do is the flexibility of the scientist being able to be the founder is great. I don't think you could my job is never to walk into a random lab, pick a scientist and be like, you can be a founder. As much as I would love any scientist to try, I think a great scientist CEO can come from anywhere, but not every scientist is a great CEO. The things that I would want to figure out is it's more of a selection criteria for me, is if I do find a scientist who I say, oh, that's going to be a great CEO, the combination of the two, it's an immediate positive signal for me as a VC to this is someone that I could definitely invest in. And then of the pool of scientist CEOs, I'm trying to find the best ones as early as possible. And so I'm trying to catch the signals, and that's where being in YC and all that kind of teaches you. I've seen Equipment Share, great founders, but at a very early stage, I saw them in 2015. And now multiple companies in my class have gone public, and I remember that they weren't necessarily they were definitely not the hottest companies in demo day. They were not the companies that had the most polish or were from the fanciest places or the best pedigrees. They really had just the longevity and a great idea, and they just pushed it longer than anyone else. And so I'm looking for that. And so as much as possible, I would like to convince more scientists to believe that it is possible for them to be a great CEO. I think that's sometimes we internalize other people's biases, and so if there's a external bias that scientists make bad CEOs, we believe it. And maybe I got lucky in the sense where I grew up in a household where a scientist was CEO every day, right? And so I just that was normal to me, and so it seems easy to me. I did it for 2 companies and it was easy for me. And I would just think it's easier for more companies than you think. And a lot of the best biotech companies in the world, the Ginkgos and Twists and Solugens of the world, they're all scientist CEO led. And to this day, Recursion, public companies, still scientist CEO led. These are all PhDs who spun out their research themselves and took it all the way to NASDAQ or the New York Stock Exchange. Right? These are just exciting opportunities. And if I can get in first check, then it's an amazing venture opportunity too.
Absolutely, I totally agree, and I strongly believe in that idea that you just mentioned. That a lot of time it's about what you believe and not about your skill level, right? And I always tell people to motivate them that it's not that you're not ready; it's just that you think you're not ready, right?
Yeah.
Just believe in yourself and take the leap, and everything works out, right? And you'll be surprised how it works out, right? So
Yep.
great message there. And now let's talk about the subsectors within biotech, right?
Mhm.
So can you tell me what are the broad subsectors or categories of deals that you're seeing at Utopic Ventures?
So I wrote about this recently. What I'm calling Biotech 2.0 is kind of the next generation. I think there's a great historical analogy between the biotech revolution that's happening now and the internet revolution that happened 20 to 30 years ago, or it started, right? And we're kind of nearing the end of the internet revolution and the beginning of the next biotech revolution. And so I would say Biotech 2.0 is very much like Web 2.0, where we're starting to get the personalization. It's starting to go one to many versus like Web 1.0, Biotech 1.0 is just we are creating these structures with a COVID vaccine where everyone gets the same vaccine. And we're just now you can see it in biotech research. The things that are in phase 1, phase 2, phase 3 are personalized, customized cancer vaccines that are based on very similar technology. And so you're going to increasingly see both on the diagnostic side, the testing side, the costs are coming way cheaper. So genetic testing is way cheaper. Like Moore's law or faster drops in testing costs, right? And so with all of that plus we're going to get much more personalized data from ourselves. So instead of the annual blood tests, we're going to get daily or by the minute the data from ourselves. That's going to help with personalization, and then the actual like technology of being able to take the mRNA and quickly customize it to an individual, and all the other gene therapies and different things that we're able to do. So the personalization of biotech in the like pharmaceutical or like medical side, that's what I'm looking for biotech 2.0. And that's one big subsector that I'm really excited about. I think a second sector that I'm really excited about is industrial biotech. And I think it's a similar reason, which is like cost or the inputs costs have come down for decades. And it's like similarly, the historical analogy of for tech is you kind of in the 90s, you finally get this internet revolution after 20 or 30 years of hardware revolution that has to happen, right? I think a lot of that is kind of what happened in biotech last 20 or 30 years. And so now what we're going to get is where biotech used to be so expensive that you can only use it for expensive pharma applications. I think you'll increasingly be able to use biotech for industrial. So you'll be able to replace plastics and cotton and like all these other household oil and gas and everything with more biotech. And if that starts happening, where the costs come down to where biotech is eating everything in the world, that's when you'd get the next generation of this. And this is the same kind of idea of the software eating the world versus biotech eating the world. I think we're right in that phase where biotech can affect everything instead of just pharma. We're already just with pharma, biotech is already the second biggest VC industry after software. But with if we can really impact the whole world, it completely changes the game.
Absolutely, I totally agree. And in terms of the kind of interest biotech gets, like AI was kind of subdued for a lot of years, and then
Mhm.
suddenly we had a boom. Like everyone is talking about AI, right? Same
Yeah.
thing with Web3 as well. Like it was going on, then suddenly we have a boom, and then a burst as well. Uh, do you think that kind of a moment can happen with biotech? If yes, then what do you think that will be?
I think it keeps coming in cycles. I think the fun thing about being on the edge with different industries, like I love being on the edge with biotech, but also I've been, investing in crypto for 6 or 7 years now, right? And I really like AI, and I had the first Oculus, and before that, I had like the Zeiss device that you could put like a phone, like a smartphone into it, and then like that created like a kind of VR environment, right? And so like I'm always trying to find the newest device for anything. And so in every one of these fields, you kind of get these generally 5-year hype cycles where things go up and down. And I really feel like biotech was its last hype cycle was 2020, and you saw it in the public markets where Moderna and all these things flew up, and then we had a big crash in the last year or two, and it's like it's going to come right back up. There's going to be another 5 years. It's like the same thing with crypto. Is like I end up not worrying about it. Maybe I try to sell at highs and buy at lows a little bit, but other than that, I don't mess with it too much. I just kind of hold as much as possible, and I kind of think the same thing is true in biotech. Is like if anything, it's a little bit of a buying time right now, right? It's like both the public markets and the private markets are down over 50% in biotech. So if there's ever a good time to buy, it's now. But generally speaking, it's more of a 10, 20, 30-year bet that you're making on biotech. And so dollar cost average in, do whatever you need to do to get into biotech. But I think it's important that's a core part of anyone's investing strategy.
Totally agree. So I'm kind of a burnt hand when it comes to crypto,
Mhm.
but I think that's just just a personal thing. Uh, but yeah, now let's move on to my last main question before we move on to the rapid fire round. And this one is about what's one change that you wish to see in the startup or the VC ecosystem.
I think we need more early stage investors. We need more people who are willing to take the true gamble on a founder. I think that the Y Combinator, Techstars, 500 startups were all created in like a 3 or 4 year. It's like 2005, 2006, 2008. They were all created in a big bunch, and there was like a whole wave of like we're going to be the Y Combinator for this little region, and like all this the explosion happened, and they kind of all came down, and YC kind of tried to kind of win the space, which is great for YC in the sense that they're going to win for those 500 companies, and those 500 companies are going to be excellent. And if you can be an LP in YC, you should do that if you have enough money, right? But other than that, I would say that it's leaving an opportunity for thousands to tens of thousands of other startups that are happening every year. Right? I think there's 50,000 startups a year that get angel funding, right? And only a few thousand that get VC, right? And so there's a big gap between the two. And if there's more people who are willing to take that first risk on these startups and shepherd them through, I think that's also a great business. It's almost like the middle stand of VCs. Like if you're a solo GP running a 5, 10, $20 million fund, you're probably not going to ever be a billionaire doing that, but you're going to like make a great living, and you're going to help great founders. Like you can help like 10 or 20 founders a year, really get deep with those founders, like really enjoy your life. Like, you won't have to go raise $1 billion. You won't have to go to Saudi Arabia. Like there's like a lot of benefits to your life about this. And so I think that there's something to be said for being a very niche, very focused VC.
Yeah, I totally agree, and I can see another blog post coming on your site called Mittelstands
I'm
of
thinking about it.
VCs. Yeah, I'll be
Yeah.
looking forward to that. Yeah, if it comes out before this episode goes out, I'll make sure to link it up in the show notes
Yeah.
below. Thanks so much for coming on, Neil. And now let's do the
Yeah.
rapid fire round, wherein I'll ask you 5 quick questions about the fund, and you have to give 5 quick answers. Sounds good.
Yeah.
All right. So the first one goes: what are the sectors and regions you invest in?
Globally and industrial and biotech 2.0.
All right. And what's the typical stage of investment?
Angel or pre-seed.
What's the typical check size?
50 to 100,000.
Where can founders apply for funding in case there is a direct way?
Utopicvc.com is there's an open application.
Great. Last one, where can our listeners follow you?
So at Neil Thanedar at Twitter, and then neilthanedar.com is where I have over 100 essays that I've written over the last 10 years.
Yeah. All those essays are great, and I'll make sure to put all those links in the show notes so that our listeners can get there easily. Thanks so much for making time for this, Neil. Pleasure having you on, and happy investing.
Thank you. This is great.
Thank you.